Have you ever watched the stock market on TV and seen those big red numbers flash during a news report? It's like watching a roller coaster, but no one really knows when or where it will crash. Ever wondered why this happens? Well, let's unravel this mystery together. Imagine you have a piggy bank full of colorful coins. Each coin represents a company. Now, if suddenly everyone starts worried about those companies and decides to take their coins out, your piggy bank gets emptier. That's kind of like what happens when the market crashes. It's people selling off their shares in panic because they're scared. But here's the surprising part. It's not just a matter of fear. There are deeper mechanisms at play. Let's break this down step by step. First, think about an order book, which is like a giant list where buyers and sellers meet to trade these coins. When everyone tries to sell at once, the prices drop quickly because there aren't enough buyers to counterbalance all those sellers. This creates that big red number you see on TV. And here's another surprising part. Sometimes crashes can be triggered by something completely unrelated, like changes in interest rates or even foreign events. It's as if a butterfly flaps its wings in one country and causes a storm elsewhere. So, market crashes aren't just about fear. They're complex systems where many factors come together to cause the ride to go down. Now you know a bit more about why those big red numbers appear on your TV screen when things take a dive. So, you've heard about market crashes, but do you really know what causes them? Let's dive in with a simple analogy. Imagine you're playing with dominoes on a table. Each stock is like one of those dominoes. When the economy is good, all these dominoes are standing tall and steady. But when things go south, it only takes one domino to fall, and poof. The rest follow suit in what's called a chain reaction. Here's how it works. Let's say you're an investor who just lost your job. You can't pay back the loan on your fancy house, and suddenly, you have to sell off that house quickly before anyone else does. When you sell, the price drops, which sends shock waves through the market. Now, remember those dominoes? The same thing happens in the stock market. Once one big company starts selling off assets or cutting jobs, its share price plummets. And when a major player falls, other companies and investors get spooked. They start panicking too, trying to sell their shares before they lose value. Soon enough, all these stocks are falling like a line of dominoes in quick succession. That's why we see the stock market crash on news channels, because once that first domino falls, it's hard to stop the chain reaction from spreading. And here's the surprising part. It doesn't even need to be a major company for this to start. Sometimes a small event can trigger the whole chain. For example, if a country raises interest rates, making borrowing more expensive, companies might cut costs by laying off workers. That layoffs announcement could set off a similar domino effect in other companies. So next time you hear about a market crash, remember, it's often just one domino that starts a long line of falling dominoes. Understanding this can help you see why markets are so interconnected and why everyone needs to be cautious during tough times. So, we've talked about how market crashes can happen when too many stocks become oversold, leading to a chain reaction of selling. But there's another side to the story, when investors get really scared and start selling in droves. It's like a game of dominoes toppling over. Imagine you're playing with dominoes on your kitchen table. Each domino is carefully placed, and when one falls, it knocks over the next one in line. That's what happens in the market during a panic sell-off. When just one investor decides to sell their stock because they're worried about something, like maybe a big company announcing bad news or the economy weakening, that first domino shakes loose. Now, here's where things get interesting. Once that first domino falls, it triggers more and more people to sell too. It's almost like an infectious fear spreading through a crowd. One investor sees their friends selling and thinks, hey, I should maybe sell too just to be safe. Then another sees them selling and decides to follow suit. Before you know it, the entire table of dominoes is toppling over. And why does this happen? Well, during times of financial panic, people don't want to lose money. They become overly cautious and rush to get out before things get worse. This herd mentality can be quite powerful. As more and more investors sell, the prices start to drop rapidly. It's a self-fulfilling prophecy. People are selling because they think others will keep selling, so they sell first. The result? Prices plummet, and it feels like everything is going downhill fast. But remember, even though this domino effect can be scary, it's important to understand that market crashes due to panic sells are usually temporary. Markets have ways of stabilizing once the fear subsides. just like those dominoes eventually come to rest. All right, let's dive into why prices falling can make things worse for the stock market. A bit of twist, right? Most people think that when stocks fall, it's just because companies are doing poorly or the economy is in trouble. But there's more to it than meets the eye. Let's break this down together. First off, imagine you and your friends are playing with toy cars on a long track. Each car represents a stock price, and everyone gets their turn to pull them forward. Now, let's say one of those cars starts moving backward. That's like the first stock falling in price. What happens next? People see that car moving backwards and think, oh no, maybe my car is next. So they start pulling their cars back faster too. This creates a domino effect. More people selling, which makes prices fall further. The funny part? These falling prices actually make the stocks seem cheaper to other players who are on the fence. Let's take it one step further. Imagine you're at an auction, and everyone starts bidding lower because they think no one wants that fancy vase. The price keeps going down, but suddenly more people want to buy it just because it's so cheap now. It's a bit like falling prices making stocks seem too good to pass up. Now, here's the surprising part. This self-fulfilling prophecy can spiral out of control very quickly. As more and more people sell due to panic or fear, the price keeps dropping. But sometimes once everyone has sold their cars, stocks at such low prices, they realize it's a good time to buy back in, because now those stocks might be undervalued. It's like if you were playing with your friends and suddenly everyone stops pushing forward. You might see that the track is actually smooth and you can push your car faster than before. That's why sometimes, after a big crash, there are opportunities for smart investors to come in and buy up at lower prices. So remember, when stock prices fall, it's not just about company performance or economic conditions. It's also about the psychology of fear driving people to sell. And that can create a vicious cycle where falling prices lead more people to sell, which then makes prices fall even further, until, eventually, the market stabilizes and starts to recover. And here's the surprising part. Many believe market crashes happen because everyone suddenly panics. But there's more to it than just fear and worry. Let me explain what's really going on. Imagine you're playing a game where everyone has to guess a number between 1 and 100. At first, guesses are scattered all over the place. But as people start seeing others' answers, they begin to adjust their own guesses based on those numbers. This is similar to how stocks behave in the market. Now, let's say there are two big economic indicators that everyone is watching, like inflation and unemployment rates. These are like your secret clues in our number guessing game. When these indicators turn negative or unexpected, it can trigger a lot of selling. It's not just because people are scared. They're reacting to real changes in the economy. For example, if the central bank starts raising interest rates to combat high inflation, borrowing becomes more expensive. This affects companies and their ability to borrow money for expansion. When this happens, stock prices can drop as investors worry about future earnings. It's like everyone suddenly realizing that they might not win their next guess because of a new rule in the game. And here's another crucial point. Investor sentiment plays a big role too. If a big company announces bad news, or if there's some political instability, it can send shockwaves through the market. It feels like everyone is getting spooked and selling off their shares. But remember, those shocks are often reflections of broader economic realities. So, while fear does play a part in crashes, it's just one piece of a much bigger puzzle. Market crashes happen because underlying fundamentals, like changes in economic indicators or sentiment shifts, are influencing investor behavior. In the end, market crashes aren't just about everyone being scared. They're complex reactions to real-world events and economic conditions. And here's the surprising part. Crashes often stem from an imbalance between supply and demand. It's not just about fear, as we've discussed. Let's break it down into something more relatable. Imagine you're at a popular concert with limited tickets available. Everyone wants to get in, so there are lots of ticket buyers, demand, and not enough seats supply. The price goes up because everyone is willing to pay more. But what if suddenly a large group of people decide they don't want the tickets anymore? Now you have too many sellers, suppliers, and not enough buyers. The price starts to drop as those eager sellers try to offload their tickets. This same dynamic happens in the stock market. When there are too many sellers pushing stocks down, it's harder for new buyers to come in and keep the prices stable. And just like at that concert, once everyone realizes they have more than they can sell, the price starts to plummet, causing a crash. Let's look at an example. Say you own a tech company stock during a boom. Everything seems fine, but suddenly, many of your competitors face financial troubles. More investors decide it's time to cash out and sell their shares because they see potential losses. The supply of that particular stock on the market surges as these sellers try to get rid of their holdings. But where are the buyers? Not everyone wants to jump ship, so some sellers end up selling at lower prices just to cut their losses. This flood of sellers drives down the price even more, making it harder for others to buy in at a good rate. The market quickly reaches an equilibrium point where more people want out than in. In other words, crashes occur when there's suddenly too much supply and not enough demand, causing prices to fall rapidly. It's like a big domino effect. Once one domino falls, the rest follows suit.